Hi and welcome to this Blueberry Markets video update with me, John Kibler, Head Currency Analyst. In this video, I'm going to be talking about the ATR indicator, how you can apply it in a strategy and go from there. So I wanted to do something a little bit different. Not too much going on in the markets at the moment. Obviously, dollar just battling for that strength at the minute. There's a bit of pressure on some risk currencies as well. So Kiwi and Aussie still remain under a little bit of pressure. So I'm looking to just do something a little bit different, something from the educational side of things. And just kind of applying the sort of trend is your friend, but also applying the ATR strategy. Now, ATR just means the average true range. And if you're on your MetaTrader 5 platform, if you go to insert indicators, come all the way down into oscillators, you can see here it says average true range, and you get this little box that opens up, and basically the period just stands for the amount of candlesticks looking back in a specific time frame. So for me, looking at something like a 7 or a 14 is absolutely fine. So if we just leave it on a 7 and just click OK, what we'll get is this line through here. And if you actually just hit the middle of your mouse button or just come up to the crosshair up here, you can see that you get some numbers here. Okay, so on a yen pair, obviously the decimal point comes first for the amount of pips, and what this is saying to me is that the average range on a daily time frame for the past 14 days is 122 pips. Okay, so that's giving us the range of the candlesticks. Now we can apply this and use this in our trading, and one way we can do this is by making sure our stop loss is either above or at the daily trading range. Okay, so what I'm going to focus on here is we had this nice little trend running through here on pound yen, where you could have looked to take a few moves out of the market, and what I'm going to do is just line up some levels of support. So typically in trend, we want to see the market form higher highs and higher lows, and then a market comes back and retests previous structure highs. So I'm just going to map out a few of those structure points. If it'll let me clone this up, here we go, through here, here, up here as well. We don't get the pullback that we desire through there. I'm just going to pop this line here as well, because technically if trend was going to continue, we'd also be looking for buys in and around this area through here. Now what I like to do when I'm looking at this daily time frame, if I'm going to trade the daily time frame approach, what I'm going to look for is when the market creates that higher high in a daily and pulls back, I'm going to look for 4-hour trading opportunities in here. This allows me to get a better entry on the turn. Okay, and what I typically look for is, if we're going to look for something called either the higher high, higher close in today's case, or we can look for something called the lower low, lower close candle on a downtrending scenario. But I'm not going to go for the downtrend today. I'm just going to go through this pound yen trend through here and how you can apply the ATR indicator to a strategy. Okay, so when I jump into this now, I'm just going to go into that 4-hour time frame. We're going to highlight a couple of these trading opportunities. Now what we're going to essentially do is switch back between the 4-hour and the daily, and we're going to look at areas where the market forms the higher high, higher close pattern, and how we can apply that in trend. So let's just take the example through, let's just remove these actually, because I'm just going to take the example above. Okay, just through here. So we get our daily time frame saying we should be looking for some higher highs. If I just grab the Control Y, it brings on our period separators, so you can see the week just through here. And we were looking for the market to come and retest that structure and form a higher high, higher close candlestick. Now, a lot of people will probably be looking at this one going, yeah, this is the perfect one here. However, we do get this retest in here, which provides a higher high, higher close candle. And what that essentially looks like is a close above the previous candlestick high. So this bullish candlestick here closes above this previous candlestick high. This alerts us to a potential trade opportunity. Price has broken higher, come back. You can also add the RSI and look for an overbought, oversold condition as well. That adds better filtered trades up. I'm just going to ignore that for now. I'm going to look at the picture here. So what I would do typically is look to buy above that candlestick high. Now in most rules, a lot of people will just look at this and go, well, yeah, I'll put my stop loss below the low through there, and end up getting stopped because sometimes the market would jump to find liquidity where common stop areas would be, and then the market rallies on. Now the ATR will help you stay out of bad trading, bad stop placement. Okay, so here it says that we're looking at 100 and what's that, 106 pips, let's say, on our stop loss. Okay, now if I jump back to the daily time frame and we actually look at the average daily range at this time, okay, so if we're looking at the daily time frame, it's saying that we need around about 97, 90 or 100 pips on our stop loss. Now what I like to do with that information is add that on to our 4-hour time frame. Okay, so it may sound a little bit extreme, but what I like to do is give my trade some breathing space. So it's saying around about we need an extra 100 pips onto this low. Okay, so it's saying 106, so it's saying 206 pip stop loss. So if I just keep dragging it down till it says 206, you can see then it gives us a hell of a lot of breathing room for the market to go. Okay, so the market comes back, it retests this structure just through here, it breaks below that low. A lot of people will be thinking, this isn't going to work out. We then get that rally to the upside just through here. So this is a really great example of when the ATR can keep you out of a bad situation. Okay, so the market comes in, comes back in, it gives you your higher high, higher close situation through there. It then allows us to place our stop losses comfortably away from that low. Market rallies in our favor. Happy days. Okay, let's look at another example. So here we have a great example. Price comes up, creates a high through here, pulls back into the zone. This produces another higher high, higher close candlestick through there. Okay, so you can look at it two ways. You can look at it at the 4-hour, but I like to go to the daily time frame again. So let's just mark up our entry. This is where our stop loss would be. Again, look, if I just pan this to the right, if we just put our stop loss below that low, it's in a vulnerable position. Okay, and that's what we want to stop you from doing. Stop placing these stop losses in vulnerable positions. So we jump to that daily time frame. Have a little look. It says on that particular day where we look to take that trade, it's saying 107 pips. Okay, so what we want to do is go back into that 4-hour time frame, go to this and say to ourselves, what it's saying here, the stop loss is, let's just, for argument's sake, say it's 50 pips. So we're looking at 157 pip stop loss. Okay, if you want to be accurate, just, well, you can look at the actual numbers through there, but around about 157, 160 pips is absolutely fine. Again, keeps you out of trouble. Okay, the market comes back down. You still want to be in this move because technically the daily trend is still in favor. It's come back into a supporting area. 4-hour jumps into this zone. You stay in the trade because your stop loss is a healthy move away. Market rallies nicely in your favor. Okay, so that is how you can use ATR in your trading. Hope you enjoyed the video. If you have any comments, let me know in the comment section below. Cheers.